And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Man, I feel like this morning, I'm like, whew, just like, glad this week is over. Vacation's next week. We made it. You know, my wife is very upset right now because we were actually supposed to be on an airplane tomorrow flying to Germany for my son's wedding. And, of course, we can't get into Germany because everything's locked down. So it'll all be done by Zoom on Facebook. So she's not real happy right now. She's been a little tough to live with for the last couple of days. But, you know, it's life goes on. We were supposed to fly to Florida next week. So after we had to cancel our trip to go to Germany because the borders are closed. They won't let you into Germany. We decided to take our kids to Florida real quick. Well, we had to cancel that trip because, Florida's now a hotbed of virus, and we're worried about getting down there. And if somebody gets sick, we can't get back on an airplane to come home. So, we said, hey, it's not worth the risk there. So we're now trying to figure out something to do. We've got all of our kids at home, summer break. It's next week is our vacation, and we don't have anything to do. So
hell hath no fury like a woman whose vacation has been spurned.
Yeah, not only did her vacation she can't go see her son get married.
Right.
Her oldest, and now her vacation's been knocked out. So yeah, she's just. I'm glad this week's almost over.
They better get this whole COVID thing worked out before your daughters start marrying. Because
hey, no. The next thing's coming up here now because of the outbreak of the virus, and here in Texas in particular, we're about to pick up and have run out of hospital beds and the IC units, and we've now broken our previous record of cases. We over 5,500, I think, is the number as of yesterday. So Texas is really kind of a hotbed of this virus. Of course, now. The problem is now we're back to the school issue. We're starting to get notices from our kids' schools going, well, we're going to rethink this whole school year. I'm like, no, you're taking them. They are not staying home for another year. People will be murdered. I'm telling you.
We'll put them in bubbles.
Child abuse cases are going to go way up. That's all I'm saying. Oh no, because they're driving me crazy. Anyway, I'm teasing. I'm joking, of course. I love my kids. They're awesome. But no, I mean, it's just seriously, this is kind of where we are right now. Within this whole thing. Look, I wanted to go through a few charts this morning. If you don't follow us on Twitter, go to @LanceRoberts on Twitter, and you can follow our Twitter feed. And every day we post, quite a few charts about markets, economy, kind of what's happening, kind of generally global. I want to go through a few with you this morning. Oxford Economics came out this morning and published a chart of the economic recovery, and this is their expectation of the economic recovery. And while it shows this 13% drawdown next quarter, it immediately returns back here to moving towards the previous GDP path. But you'll notice that it doesn't quite get back to that path. Now, this is moving all the way out to 2023, mind you. But the reason I bring this up is because this is very similar to the chart that we built last week, actually about 2 weeks ago, showing the same thing. Now, this is what Oxford Economics didn't tell you, was that when we get this recovery back, it will be lower than the trend line was before the financial crisis was over. We never actually got, after the financial crisis got back, we never got back to the long-term trend growth of the economy going all the way back to 1947. So every time we have these events that slow the economy down because of the increase in the debts, the deficits, which erode economic growth, we keep stair-stepping down the economic growth rate. And coming out of this, even if we return back to the previous growth rate trend of where we were back in 2008 through 2010, we will never actually recover back to the previous trend line. We continue to have these steps down in economic activity because of debt, because of the deficit that we're running, because of lower economic prosperity across the board. And when you're talking about 49 million people unemployed, and that's likely to get worse with the number of bankruptcies that we're watching rise today, at 7:30, we're going to probably see another million or so in terms of jobless claims. And while that number is lower than what we've seen over the course of the last really, few months, 1 million is still higher than any other point in history of jobless claims at one time. So, we're still seeing record numbers, even at 1 million. It's come down a lot from the original 6 to 8 million, but it's still a historically high number at 1 million. That's going to provide long-term drag on markets and ultimately on the economy. The point here is that as we continue to look at what's happening in terms of the economy, this is a really important point longer term. And again, while we look at this and we talk about this, we're back to this point now of beginning to talk about these stimulus packages that are being kind of put out through the economy. Steve Mnuchin out yesterday, Treasury Secretary, saying, hey, we're likely to pass another stimulus package in July as we start to run out of benefits. And this is important because the problem is that as we run out of these benefits, that's going to be a reduction of income to households. And while the market is functioning here, right now we see companies raising more debt than they have before. American Airlines out just yesterday putting out another $2 billion worth of bonds. Corporate bond markets are working fine. We're seeing a record pickup on the amount of corporate bond borrowing, but this is still a problem if we don't get money back into the hands of the consumers here pretty soon. The problem now is that Congress isn't even talking about another package. We haven't heard anybody talking out of Congress about needing another package, getting another package at this point. So we're not really seeing any type of movement forward. So while Steve Mnuchin is trying to kind of talk up the markets here that, hey, hopes we're going to get more packages, we're not seeing it. The Federal Reserve, though, in the meantime, still putting a lot of stimulus into the markets, even though the markets really don't need it. Corporate bond borrowing is not a problem at this point. Lastly, when we talk about earnings per share, we're starting to see these earnings estimates still ratcheting down. This is going to be problematic for, again, valuations. We're still using this idea that we're using earnings 2 years into the future. While earnings estimates appear to have stabilized here a bit, we're about to get into earnings season. Economic growth is going to get weaker. And if we do have this resurgence of a virus here in the United States that reduces consumption, reduces people getting back out into the economy, these estimates are going to come down a whole lot further. But again, these are the big issues here. We're watching markets perform. We're at very extended levels based on where we are globally. And this is going to be one of the problems that as we go forward is that economic growth really isn't supportive of what's happening in the economy and really what's not happening in terms of prices. So investors continue to really overpay here for what they're actually getting in terms of earnings. And as we move into quarter two earnings season, we're going to start getting a lot of guidance from companies talking about just how the coronavirus has impacted them and what the expectations are going forward. And my suspicion is that because of weaker economic growth, because of what's happening on a global basis, because we're going to have this resurgence in the virus here in the short term, that guidance is going to come down a bit more. Apple, as an example, closing stores. We just had a list of stores, Apple stores here in Houston that are now closing because of the virus. And that's not going to be here just in Houston. That's going to be nationally, globally. We're going to see a lot more companies begin to do that. Starbucks closing down stores. Those all have impacts that are ultimately going to impact corporate earnings. We're paying way too much for stock prices in terms of relative valuations. It's also going to have an impact on the economy and jobs. All that's going to be coming up, so pay attention to what's going on here. Okay, quick break. We'll come back. You can get all these charts today right on Twitter if you simply follow us at Lance Roberts on Twitter. Get all these charts more. We post a few every day for you, so they're always there for you to keep you kind of up to date. Also get by the website, realinvestmentadvice.com. New articles out this morning, and our macro view and newsletter will be out tomorrow and Saturday. So make sure you're registered at the website, realinvestmentadvice.com. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
Everybody get up!
I love it when the propaganda machine is out running full force in the
in the economy.
Cheap entertainment.
Well, no, it's just, it's interesting. It's, people are all addicted to social media, right? And Twitter and all this other stuff. And of course, they get these snippets of, information released, by the government, and the media picks it up and runs with it. And of course, that's the narrative that you believe to be true. And, this is for everything, right? Going on in the world today. It's every country, no matter where you live in. If you live in China, the propaganda machine from China, tells you that, this is, how things are, and that everything is great here and everything sucks everywhere else. And if you live in the U.S., we tell you how great things here, are here, and everybody else sucks. That's just the way the propaganda machine works. And I love this headline this morning because this is the propaganda machine running full force. You're right here in the U.S. U.S. releases list of 20 Chinese firms backed by the Chinese military. Shocker. TikTok. Right? Mm-hmm. One of the great Chinese firms. They're just sucking up all your data, and everybody, all these millennials are on TikTok sharing videos, sharing all their personal information. China's sitting there going, "Yep, give it to me. I'll take all of it you can give me." Right? Ladies and gentlemen, let's talk about a few U.S. companies: Google, Facebook. If you dig down into these companies are backed by the CIA. And, the whole asset, information gathering machine in the U.S., Edward Snowden, while he was, beaten down because of his release of information, whether or not you believe he's a patriot or a traitor, I don't really care. But what he did expose was the data collection that the NSA is doing on American citizens, right? If you honestly think a lot of these tech companies are not backed by the U.S. military, NSA, CIA, you're kidding yourself. So, I love, like I said, the headlines are always interesting, but man, you've got to really kind of understand what's happening. Anyway, I don't want to get off on that, but it was just that the headline struck me because, the media does a great job of controlling the narrative. And if you don't, really dig down behind the story and get out of your echo chamber of your Facebook page or your Twitter page where you block everybody that disagrees with you and you only follow people that agree with you, you get what's called confirmation bias. I read a lot of history books. I read a lot of books, period. Read lots of stories. And of course, you have to go through and really kind of dig down through these things. And it's amazing how many people believe, one set of narratives versus others without doing the research. And it's a very interesting, and they leave out, you read a book and it's like, this book, confirms my views, but it leaves out very important points. And I'm reading a book right now, very selective parts of history. It's great. It leaves out huge chunks of history that are relative and important. But that's the point. You've got to really kind of put these things, kind of all into perspective to form a better opinion and view, particularly when it comes to investing and markets, what's really happening, because that's where the ultimate outcome is going to be for investors. When you look at, investing now, the mainstream media is like, well, the Fed has the back of the market. You've got to be invested. You've got to buy. For some reason, this is translated to you have to buy bankrupt companies like Hertz. We have a gentleman working with us right now. His name's Cole, and he's been working with us here in the studio for the last couple of weeks. And we were talking about GNC yesterday. He comes in and says, "See, I told you GNC's up like 95%." 95% overnight. GNC's filed for bankruptcy. So this is the great idea, right? We a company files for bankruptcy and we buy their stock. Now think about that for a moment. But that's what the Fed has fostered, right? This is the belief, is that no matter what happens in the markets, no matter how bad the economy gets, no matter if a company files for bankruptcy, the Fed's going to fuel the advance, right? There's just all this liquidity. It's got to go somewhere. And that's not entirely, and look, that narrative is not entirely wrong short term. Right? That is the case, because it's not the Fed liquidity that's doing it as much as it is the belief the Fed is providing a put that is fueling investors to chase markets. So by the Fed's actions, they have encouraged speculative risk-taking by investors to move markets higher and to heal up financial instabilities in markets like the bond market. Again, like I said in the opening monologue, is that there was, the Fed came in and was injecting, trillions of dollars into various areas of the bond market to make sure that credit was flowing. And there is no evidence that the bond market is in trouble. We're getting record issuances of investment grade bonds. We're seeing investment junk bonds go to market, get taken up by investors. American Airlines just did a 12% secured bond. So, those are, there's nothing wrong with the bond market. It's functioning. And yet we're still providing this liquidity. And and the point about this long term is that now investors are coming up with an excuse saying, okay, yes, I'm going to overpay for asset prices today based on earnings that I think will be there 2 years from now, 3 years from now. The problem with that is that you're locking in no price appreciation for 3 years because ultimately valuations are going to matter. And when you're using returns 3 years in the future to justify what you're paying for today, what are you going to do 3 years from now, right? That's, if you don't get just stellar, earnings growth over the course of the next three years from here to there, you're going to have problems. And there's nothing to drive that massive earnings growth over the next 3 years. We've already cut taxes, so we're going to cut taxes to zero. You got to have some income for the economy and for the government. So, you're going to cut corporate taxes to zero, or we're going to cut personal taxes to zero. I mean, what are you going to do to provide another boost to earnings when you have slower rates of economic growth? So the reality of what's happening is going to come back to haunt us down the road. And so this is why it's important. You've got to look at both sides of every story. And when you read a headline story about, earnings growth is going to be great, we're going to recover back to where we were, the GDP, we're going to have this very sharp V-shaped recovery. But when you look at the numbers, we don't actually get back to where we were previously. And if we don't get back to where we were previously, then earnings growth is going to be lower as a function of that than where we were previously. And so, these things are not completely detached from each other, but when you're making investments and when you are, and particularly when you're in the markets and working, you've got to understand that ultimately valuations matter. It may not seem they matter at the moment, but valuations ultimately matter. What you pay for today is going to matter in the future. If you overpay for it, you're not going to get the return that you expect down the road. And, this has just been there's long periods of historical precedent that prove this to be true. We may not think that's the case in the short term. We may say, well, I bought GNC yesterday. It's up 100% today. Well, that's speculation and that's gambling. And that works in the short term, as long as you remember the other half of the trade, which is to actually sell it. There's, a bunch of people bought airline stocks. They ran up. They didn't sell them. They've run right back down again. Hertz ran up, ran back down again. So you've got to actually have two parts of the transaction. You have to buy it and you have to sell it. But that's trading, and that's okay. There's nothing wrong with trading. People, they malign traders and they say, traders are losers, whatever. But there's nothing wrong with trading. It tends not to work out well long term, but you do have to manage risk and manage exposures. And, these things all have cycles, and we're in the midst of that cycle. And the point here is that just make sure that you're not locking yourself into a period of confirmation bias. We tend to all read what we want to read. If you have a very bullish bias and you think the market's only going to go higher from here, you tend to only read articles that support that view. If you think that markets are going to go lower from here, you tend to only read those arguments or those ideas that support that view. And the problem is that, and this is, when we write articles, we talk about, hey, we're in a bull market now, but pay attention for this risk. We have to analyze both sides of these equations to make sure we don't get ourselves into a trap. It doesn't always mean you make the right decision, right? There's, the part of investing is making, educated guesses. That's part of it. And sometimes those guesses work and sometimes they don't. And that's just part of it. Doesn't mean you're a loser. Doesn't mean that if you made a wrong decision that you shouldn't be investing. It just means you got to sell that and do something different, right? You got to fix that problem and do something different. But that's the real issue. And focusing on making sure that you're analyzing both sides of the argument will help you be a better investor longer term. It won't eliminate the potential for mistakes, right? I mean, you're still going to make mistakes as an investor. That's just part of the investing game. But making more educated guesses will lead to better outcomes longer term. Okay, quick break. We'll be right back.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
And welcome back at 6:32 as we get back to the show. So this book I'm reading right now is I'm actually writing this article. I'll have the first part out on Monday. I'll have the second part out next Friday. It's Stephanie Kelton's new book on modern monetary theory. And, so again, when you read the book, her analysis for why modern monetary theory is a viable option for the U.S., she leaves out big chunks of history where clearly there is evidence that, socialistic policies don't work and have never worked. And again, it doesn't matter where you go. Anyway, I've got this 2-part series coming out next week, kind of going through this. So you don't have to read the book. She actually did a video. So I took the video, I transcribed the video, and I'm just basically breaking her video down, which covers basically just, the entire book is summed up in a 9-minute video. So, it made my job a lot easier. But, it's just, as we go through and break down her arguments, you start to see the fallacy in MMT. But again, this is part and parcel, though, of what people are wanting right now. Right now, as an example, 30% of people's incomes come from government spending, right? Or government grants, so to speak, right? So unemployment benefits, checks to households, whatever it is. So 30%, I think about 30% of disposable incomes are now coming from government transfers. That is MMT. That is helicopter money, however you want to phrase it, but that is modern monetary theory, right? We give money to households, they run out and spend it, and everything is fine. What is forgotten, though, and let's just set up a real life example for a second. There's 3 of us in the studio right now, right? Me, Brent, Cole, we're here. So I'm the government, Brent and Cole are the population. I'm going to give each of them $1,000 this month to spend. So they run out to the economy, and our economy is only 3 people, all right? There's 3 people in the economy. They run out and spend their $1,000. Well, once they do that, I'm going to give them another $1,000 next month, so forth and so on. So as long as I give them the same amount of money, my economy will be stable at that rate. It won't grow, right? And if coal dies off for some reason, then the economy is going to be cut in half because there's only Brent spending money. The problem with MMT, though, is in order to create ongoing economic growth, you need to give more and more money for 2 reasons. One is that as I give you the same amount of money every month, you're going to spend that amount of money. That's where your lifestyle is going to be. What's going to happen in the economy is that all the prices in the economy are going to lift or rise up to that level. So, for instance, if it cost Brent and Cole $600 a month to live on right now, and I give them $1,000, in a couple of months, the cost of the things they were buying, their rent, their food, their gas, whatever it is, their clothes, are all going to rise up to that to absorb that $1,000 a month. It's inflation, right? So now, as a government, I've got to give them $2,000 a month. So for a while, we get an economic bump. Everything comes up to that level and then stops. So I've got to give them $3,000 a month. And this is the problem ultimately with ideas like MMT and socialism and communism, is that ultimately the government stops giving you more and more money. And economic benefit slows, the economic value degrades, and the economy struggles. And look, you may like the idea socialism and communism and all these other ideas. You may like them in principle, right? But all you have to do is look at the differentials between the United States and every other country in the world. If you live in the United States and you make $30,000 a year, I've talked about this on the show before, you seem poor, right? You seem poor in this country. You're in the top 1% of income earners for every other country in the world. You're in the top 1% at $30,000 a year. People living in other countries under other economic systems would love to be making $30,000 a year. They would have a fantastic lifestyle at $30,000 a year. But see, we take that for granted because we've prospered so much in this country because of capitalism and allowing capitalism to work that we've created we're not talking just about a little bit of wealth between the United States and every other country. We're talking about head and shoulders, massive amounts of wealth difference between us and everybody else in the world because of capitalism. Now we're destroying capitalism. At every single turn, what the Federal Reserve is doing is destroying capitalism by supporting companies, not allowing the process of bankruptcies to work, not allowing the process of capitalism to work, weeding out the weak, allowing the strong to survive. We're not allowing that to happen. We've bailed out banks, we've bailed out corporations, we've bailed out, everything that moves, right? The Federal Reserve is destroying the very fabric of capitalism. Government is destroying the very fabric of capitalism by passing rules and regulations and policies that they really have no business doing. The government's responsible for two things: national defense and infrastructure. That's it. Everything else is part of the states. Education needs to go back to the states. Healthcare, go to the states. States need to be responsible for their own stuff and their own people. But because of government overreach and because of power and control and these type of things, we've continued to pass policies that continue to erode at the very economic fabric of the economy as well as capitalism. So we no longer have capitalism anymore, right? We have this crony capitalism now. And that doesn't benefit the vast majority of the economy anymore. It benefits the few. And because of what we're doing with monetary policy on top of it, we're continuing to exacerbate the wealth gap. And it'll get worse coming out of this crisis. And because of what the Fed is doing, that wealth gap is going to get worse between the top 10% and the bottom 90. It'll be the top 5 and the bottom 95. And we'll see these stats over the next few years as all this starts to play out. And this isn't just a function. I'm not just guessing at this. I mean, this is decades of trend that continue to follow. And we saw it ramp up and exacerbate itself after 2008, and we'll see that same process again. But without understanding our history and understanding how these dynamics play out and looking at what other countries have done and have had these same results, is problematic. And like for instance, Stephanie Kelton, one of her big points is, and I love this one, she goes, take a look at Japan. They're running a 250% debt to GDP ratio. They're fine. Really? Kids can't leave home because they can't afford to buy a house. They can't afford to rent. They have to. They live with their parents. They won't get married because they can't afford to support their families. They've got a national pension system like our Social Security system that is just, it's a disaster. The government has had to buy 80% of the ETF market. They roughly own the entire bond market in Japan just to keep the game going at this point. And yet here's a country that can't generate more than about 1% economic growth. They have rolling recessions about every 3 years, and their inflation rates and interest rates are near zero because they're in this massive liquidity trap. But yet Stephanie Kelton thinks we should be like Japan because we can print our own currency and run 250% of debt to GDP. Does that really sound like the economy you want to be? But this is the problem, right? It sounds good, right? If I tell you, hey, I'm going to send you checks to your house, and it doesn't matter. You can go out and do whatever you want to do. Hillary Clinton, said this about the Health Care Act when, the Obama administration was trying to pass the Affordable Care Act. She goes, hey, you know what? We just need to pay for everybody's health care. And that way you don't have to worry about health care. You can just stay at home. You want to be an artist. You want to be a musician. You can just do that, right? You don't have to worry about anything. We're going to take care of it. The government's going to take care of you from cradle to grave. It doesn't work. What drives economic growth and prosperity ultimately is people producing. People having the opportunity. If I have an idea and I say, you know what, I have an idea, I want to create. I think people want to be picked up in strangers' cars and driven to places they want to go. I'm going to start an app that does that. That's capitalism, right? And you can build a business off of that. I think people are generally lazy and they don't want to actually go out to restaurants. So I'm going to create a business where people go pick up food and strangers deliver it to people they don't even know. This is awesome. I don't know what's happening to my food between there and here and what they're doing to it while they're in the car. And, I keep getting, half my French fries. But hey, it's a cool thing. Right? That's capitalism, right? We have the opportunity to do that. You don't have that opportunity in other parts of the world. You don't have that ability. And unfortunately for millennials and for Gen Zers that are coming up and for millennials kids, I don't know what we're going to call millennials kids. That's going to be the next name to come up. But when millennials start having kids in droves, that generation is going to have less and less opportunity because we're on this path. Because we like the idea of the government taking care of more and more stuff. Well, why should I work so hard if the government will just take care of it? Because you should work hard, because working hard is what gives you the opportunity to make more money. The American dream is not buying a house. The American dream is achieving income and wealth through production that affords you the opportunity to buy a house and to buy a piece of real estate and to say, yes, I'm a homeowner. It's being a homeowner and putting yourself into massive, levels of debt to where you're barely getting by is not the achievement of the American dream. That is not, home ownership is not that. Buying the house is the representation that you achieve the American dream, which is to create wealth and prosperity in a capitalist system. And we're destroying that very fabric through ideas like modern monetary theory. Anyway, I'll have the article, part one of the article out on Monday. We'll have a follow-up on it on Friday of next week. And those will be on the website, realinvestmentadvice.com. We'll be right back.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Hot stuff, baby.
Hot stuff, that's it. I was trying to tip my tongue, and I just couldn't quite get it there.
Yeah.
6:47 as we get this pre-Friday edition of the Real Investment Show kind of wound up here. So, one of the hot trends to invest in probably over the course of the next couple of years is going to be weight loss. Article out this morning. The U.S. is already the most obese nation in the world. And thanks to Quarantine 15. Was that a typo?
The Quarantine 15?
Yeah.
No.
I know.
For some people, it's the Quarantine 30.
Exactly. The Quarantine 15 is that people were gaining on average about 15 pounds while they were in quarantine, right?
Taken from the college 15, the freshman 15.
The freshman 15, freshman 10, whatever it is. Of course, when you get to college, the first thing you do is just eat pizza every day.
Oh, yeah, because it's free.
For the most part, yeah.
The meal plan, it's free.
It's free because it's on the parents' credit card. Then the parents get the credit card. They go, whoa.
Sophomore year's much, much different.
Yeah, exactly. This is why my kids are being schooled right now, is that when you go to college, you will pay for it yourself and you will not be using our credit card. So
yeah,
get ready. So according to the Obesity Research Clinical Practice, roughly 22% of Americans, this is based on a sample extrapolation, said they gained between 5 and 10 pounds since the coronavirus lockdowns. Within those who gained 5 to 10 pounds, there's significantly a higher percentage of the total sample who reported they actually increased eating in response to sight and smell, boredom, and stress. And that is kind of the problem, right? I mean, it's, you're at home all day and it's like, I'm bored, go downstairs, see what's in the pantry.
Chomp, chomp, chomp.
Yeah, exactly. And this is why, it's very important to try to, eat healthiness. But there has been another trend to this, though, is that millennials learn to cook. They actually, because, you couldn't go to a restaurant, right? So you had, if you're, younger and you've been, in this process of where your lifestyle is basically just go out and eat every day, all of a sudden they actually had to learn how to cook. And so cooking shows actually became pretty popular. People were watching cooking shows, learning how to cook things because you didn't have a choice. If you wanted to eat something decent, you had to learn how to cook, or you went to the store and bought Spam. Because canned meat sales apparently are going through the roof right now.
You think?
Which following this will be the problem with a surge in cardiac arrest from the sodium. So, and probably if you're eating a lot of Spam meat, you've probably gained 10 or 15 pounds. Don't worry about it. It's water retainage.
Yeah.
That's all it is. So,
but the cadavers will be well preserved.
Exactly. So, canned meat sales going up. But GNC, we were talking about this earlier in the show, GNC filed for bankruptcy, which I don't really get. Because if you listen to this radio station, about every commercial break, there's an ad for some type of, text this number and we'll send you your free sample of this. It's going to make you more virile, stronger, healthier. It's some pill from it, and it sells out like gangbusters at GNC. Okay, if it's selling out so great at GNC, why is GNC go bankrupt? So
it's those free bottles that they offer. That's what's doing it.
It could be the case. It could be all the free bottles.
So is GNC's bankruptcy a reorganization, or are they going to liquidate?
No, this is actually they are looking to sell. Yeah. So basically, this bankruptcy is a little bit different than others because a lot of times a company will go through bankruptcy. They just reorganize. They fix their debt problem. And the shareholders basically get wiped out. Creditors are converted to some degree. They get some dollar value on their debt. The remaining part of the debt is generally converted to new equity. And the company, they come out of bankruptcy, go back to work. Kind of much leaner structure coming out. In this case, it looks like, though, that GNC is going to file for bankruptcy and then either sell its stores, close a bunch. But GNC, as we know it, is likely not coming back. Which, for people speculating on GNC, there's your clue.
You think?
Yeah. When GNC sells, GNC stock will be worth zero. It will not be transferred to, in other words, when GNC sells their business, whatever's left of it after the bankruptcy, your GNC shares will not become part of Weight Watchers if they sell to Weight. I'm not saying they're going to sell to Weight Watchers. Don't go buy Weight Watchers because they're buying GNC. Wouldn't that be funny if it turned out to be the case? But the shares will just go to zero. They won't be worth anything down the road. And this is the same way with Hertz and all these other bankrupt companies. That's just the way bankruptcy works. But it is interesting because now we've got this kind of trend change in a younger generation. They learned how to cook. They're starting to shop more. And what they're realizing is hey, you know what? I'm actually saving money by this. And this has been a great thing for my household, right? We have been, eating at home a whole lot more, spending a whole lot less. And, we're just have been able to save, a lot more money. And we've got 4 kids, so we're constantly having to haul them around and do things and take them here and take them there. And that's all been locked down. So all of a sudden, we're saving a lot of money. We're like, hey, I hope this kind of quarantine thing doesn't end for a while because we're going to be financially really well off if we can keep this up for a while. But this is, and a lot of people are starting to realize this. And this is, they ran a poll a couple of days ago, and they asked Americans what their biggest financial regrets were. And we talked about the problem of the average American, not having can't meet a $500 emergency, doesn't have any money in the bank, live paycheck to paycheck. We talked about all these things. And this was really kind of revealed by this poll. They said, what's your biggest financial regret going into the coronavirus? And the regret was primarily about 1/4 of the respondents were not having enough emergency savings, right? I didn't have enough money in the bank to, weather out a problem. And, this is the one thing we always talk about, which is that, as an individual, we need to make sure that we've got our financial preparedness together, just like we prepare for, potential hurricanes, or we prepare for, potential events. We also have to prepare for the unexpected, because job loss and economic downturns and all that, they're always unexpected. Everybody's like, well, nobody saw that coming. Nobody ever sees it coming, right? In 2007, we're going gangbusters. People are flipping houses that have no business flipping houses. Everything's awesome. There's no end in sight. And this is the new paradigm, right? 1999, we're buying .com companies that don't have any financial stability whatsoever, but hey, that's okay. It's all going to work out in the end. But, there's always the one thing that comes along that trips everything up. And, it's like you're running full steam ahead and all of a sudden somebody sticks their foot out and you're flat on your face. That's what happens every single time. So part of emergency savings is exactly that. It's emergency, right? When something goes wrong that you didn't expect. And, the reality is that as people have gotten into the situation, they didn't, even though they were getting government benefits, they had increased unemployment checks, they had direct checks to households, they still had to go tap 401k plans or other assets just to make ends meet, because they didn't have a budget, they didn't have a financial plan at home, they didn't have these type of things that allow for a consistency in their living environment. And this is why, look, and these aren't complicated, but budgets are 4-letter words. Nobody wants to be told what they can and can't spend, right? Everybody hates that. When I, as an example, when I got married, I love my wife more than life itself, right? But she hates it. Do not tell my wife what she can and cannot spend. She's very frugal, but don't you mess with her household budget, because that's her domain. So in order to make sure that, and she does a great job. She's very frugal. She really watches what she spends. She always stays within her budget the way she wants to do it, but don't tell her what to do, right? And she likes that control. So in order to have that control, we set up a specific account, we fund that account, and she can spend that account to zero every single month. And I deal with all this. My job, save money. I save and invest. That's my job in the household. Her job is to make sure the household runs. That's just the way we did it, right? That may not work for anybody else. That was just the way we did it. And, for people in general, and especially when you're married, the biggest problem is getting two people on the same page of any type of budget or savings plan, and making sure the household is functioning and that you're actually, saving money and preparing for these other things. Most time it's one person is doing one thing or doing like everything, and the other person, really isn't involved. And I see this a lot when I meet with clients. And this goes both ways, mind you. The husband and wife will come in. The wife says, "Hey, Jim handles everything. I don't even know what's going on. Jim handles it. I don't like it." Same. I've had the exact opposite. The wife comes in. She goes, "I handle everything. Bob knows nothing." So Bob plays golf every day. I do this. That's okay. However it works. But the problem is that both people have to be on the same page. And, if you have one person that's doing all the spending and one person that's trying to do the savings, that's the majority of Americans, by the way. That's the majority of couples and relationships. And the reason that's true is because Dave Ramsey has like 100 million people that follow him because they're broke. Right? Dave Ramsey is a genius. He sells products to broke people, and there's about 80% of the population that is absolutely broke. I'm over here trying to manage money for 2% of the population. Who's got a bigger audience? Dave does, right? I missed that trade. But that's the reality of the situation, right? Credit card debt, student loan debt, auto debt, home debt, mortgage debt. We're told we have to have these things. You have to have a nice car. You have to own a house. You have to do. No, you don't. You don't. There's nothing that says that you have to pay for your kids to go to college. There's nothing that says that your kids have to go to college, right? there's other alternatives. We've been ingrained in this belief by the media and by advertising and by commercials and by stereotypes and by society and all these things. Those decisions are all up to you and how you approach it and what's important to you. If you tune out the commercialism of the economy and focus upon the finance, you're going to discover that there's a whole different way to approach the way that you live and save and earn and grow and build wealth, and everybody can do it. It's just a function of choosing to do so. But, we'll see. But one thing I do think is going to happen coming out of this coronavirus is I think we are going to see a change. Just like we saw coming out of the Great Depression, saw a change in attitudes about savings and investing. You're going to see the same thing coming out of this as well as the world gets back on its feet. Okay, wraps up the show for today. RealInvestmentAdvice.com. Our latest articles are out. Blog posts. Our articles on MMT will be out next week as well. So make sure you go by the website, RealInvestmentAdvice.com. Also, check out our latest podcast with Jim Mascura on the website now, on our YouTube channel, RealInvestmentAdvice.com. Stick around. Chris Salcedo's coming right up.
It's a rich man's world.